Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. First question, Connie. She says, my husband and I used to be able to itemize deductions for taxes, but now we don't do it anymore. But really, we'd like to be able to do it again. What can we do? All right, Connie, well, I know exactly what you're talking about. It's because of the changes that occurred almost 8 years ago now under the first Trump administration. The good news is that you're probably paying a lower percentage tax overall than you were before that tax change. Again, 7 or 8 years ago now. Although it may not feel like it because you can't itemize it, because here's what happened, Connie. They raised the level of the standard deduction and capped certain deductions. So before, the standard deduction was a small number. Now you're married, you can have a standard deduction this year of as much as $30,000 a year. So you only itemize if your deductions are greater than that $30,000. Now here's the rub. Before, if you lived in a high tax state, where maybe real estate was expensive, you paid a lot of property tax, you paid a lot of state income tax, you could deduct all that. Well, today, you can't. You can only deduct $10,000 as an itemized deduction. So because of that kind of SALT limit, you are now restricted and need to find another $20,000 of other deductions on top of the $10,000 to exceed the $30,000 threshold that allows you to itemize. So let's look at an example. Say you have $500,000 mortgage that you've had for a few years, 4% interest rate. That 4% of $500,000 is $20,000 in mortgage interest. Even with this substantial mortgage interest, you still can't just itemizing because you're limited at $10,000 of tax deduction between your state income tax, and say like a high income tax state like Connecticut, which we all know is like it can be as high as 7%. Your property tax, right? Again, all capped at $10,000. So even with a $500,000 mortgage, you can't really itemize unless you have significant charitable donations. Now, could you potentially go, move in, get more debt, buy a bigger home, take out a bigger mortgage? Sure, right? Possibly. But even now, the limit on new home mortgage deductions is $750,000. That's it. And with today's interest rate at 7%, 7% of 750, mortgage $52,500 in interest. So yes, with a bigger house and a bigger mortgage, you could potentially itemize. But if you watch these Ask James questions we do, it's probably because you're retired or close to retirement, and you got to think carefully about whether taking on more debt makes financial sense just to save some taxes. So this strategy could end up costing you more in the long run than it saves you in tax benefits, especially during what should be your income-focused retirement years. Now, another option is increasing your charitable giving, but that only makes sense if you have, charitable intent in the first place. Remember, you get the deduction because you've given away your money. And my suspicion is if you are highly charitable, you're probably already maxing out what you feel comfortable giving away. So there's not much room for additional tax savings there. So unfortunately, the tax code changes have made itemizing more difficult for many retirees, which I understand can be frustrating when you've been used to doing it for so many years. The system now favors taking the standard deduction for most households in your situation. But that doesn't mean there aren't other tax saving strategies available specifically for those in or approaching retirement, right? So we talk about all different ways if these Ask James questions and different things you can do to help save taxes. So go through our inventory, check it out, check out past videos. But we often talk about strategies that might be more appropriate for your situation because everyone's situation is a little bit different than trying to force itemization in this kind of new tax environment. Great question. Thanks so much. If you have a question that you would like to send in, you can do so. Email it to us. Email it to poollocke@poollocke.com. All right, our second question of the day is from Jeff. He says, I'm retired and I heard about this IRMAA tax. I do not want to get caught by surprise with a tax, so what do I need to know? All right, Jeff, the dreaded IRMAA tax, right? Well, first of all, IRMAA is not really a tax, even though it's referred to that way, Jeff. It's really where, your income, if your income is over a certain level, $106,000 per year if you're single, $212,000 if you're married, at which the cost of your Medicare Part B and the cost of your prescription coverage goes up, but it phases in. It phases in if you're single up to $500,000 in income. So the phase-in period is from $106,000 income to $500,000. If you're married, that phase-in is $212,000 to $750,000. So again, it just causes your Medicare Part B and your prescription coverage to cost more. But what if you max it out, right? What if you get, what if you get up to that $500,000 as a single taxpayer? Well, then the extra cost would be an extra $500. So let's put it in perspective, Jeff. If you're going to be at $115,000 in income and you can engineer it down to $106 and not pay anything extra, great, good job, right? You might save yourself $100, not $500, right? Just $100 because you're in the phase-in period. But let me ask you, if you're making $500,000, do you really care about paying an extra $500 a month for Medicare Part B? For most people, they'd say no. Or if you're married, and if you're an extra $1,000 a month, right, between you and your spouse. But again, if you're making $750,000 a year, do you really care about spending an extra $1,000 a month? Probably not, right? But again, if you're going to be at $220,000 of income as a married couple, and you can get it down below that $212,000 and save yourself maybe $150 a month, in that phase-in period, maybe it makes sense. So again, you have to look at where you are. Are you close enough that you can actually get down below it? Now, for those who are focused on retirement income investing, this is particularly important to understand. Different income sources are treated differently for IRMAA calculation purposes. For example, distributions from your traditional IRA, 401k accounts count toward your modified adjusted gross income, MAGA, M-A-G-I, which is what determines those IRMAA surcharges. However, qualified distributions from Roth accounts don't count towards this threshold. This is why I often recommend that my clients who are concerned about IRMAA consider a more diversified retirement income strategy. Having some tax-free income sources like Roth accounts, or even certain types of life insurance policies with cash value can help you manage your taxable income levels in retirement. Some retirees might also benefit from timing their income. For instance, if you're going to have a large capital gain in 1 year from selling an investment property or a significant stock position, you might want to plan for that and potentially offset it with charitable giving or other deductions if you're near an IRMAA threshold. Municipal bonds can be another excellent tool for income-focused investors worried about IRMAA thresholds. The interest from these bonds is generally exempt from federal taxes and won't factor into your modified adjusted gross income calculation for IRMAA purposes. And if you're not yet 73, haven't started your required minimum distributions, you might have more flexibility to manage your income levels through that strategic Roth conversions or other kind of planning techniques before those mandatory withdrawals kick in. At the end of the day, if you can't reasonably get your income under these thresholds, my best advice is don't worry about it. Don't worry about it too much, because ultimately it's not that big of a deal in the grand scheme of things. If you're making the income, you're always going to have more left over to enjoy it anyway, even after accounting for these Medicare premium increases. So don't stress over it, but those are the rules. And knowing them helps you make informed decisions about your retirement income strategy. Hope that helps, Jeff. Thanks for the awesome question. As always, if you'd like to send in your questions, you can do so by emailing them to poollocke@poollocke.com. If you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source, and I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear.